Santosh Kumar Singh is here with us to talk more about markets. Santosh, afternoon, good to see you. Hope you have recovered fully, feeling better now. Well, talk to us about the valuation of the market. What went by in your mind when you were looking at the screen day before yesterday? All of us thought that the much awaited correction, cleansing of froth would happen, but we barely corrected for a day and everything came back.
Yeah, so see, if I'm looking at the market, the valuation seems like they are inching closer to one standard deviation on the Nifty side, right? And that's where my view is above that, I don't see a re-rating. Above that, a lot of froth starts to kick in. So I'm not expecting it to sort of go above that, right? And that's where the EPS growth of the market comes into place, right? The EPS growth seems to be doing okay, around 13% EPS growth for next couple of years. So the market may give that sort of return, but yes, it's not going to be, my view is not going to be a huge re-rating from here on. And say on a daily basis, I don't know what happened the day before and why market corrected, but the view is simple that yes, there could be some days because there are so many areas where there is so much of froth that there could be some days where you could see some big correction happening in the Nifty.
Right. Santosh, industry guys are telling me that your AMC has raised a very good chunky, body of money from the NFO, the small cap NFO. I mean, that's the kind of, your smile on the face tells me that that news is correct. I am gathering 1,300 crore odd has been raised in the small cap NFO, one of the highest fundraisers for a small cap in a long, long time. I don't want to comment on that. What I want to know is, markets' eagerness to load on more and more of small caps. What are your thoughts on that basket right now? Or is it incorrect to paint the entire small cap basket with the same valuation brush?
Definitely, because see, the thing is, when we talk about large cap, right, we generally take Nifty 50, and the large cap is only 100 stock, right? So Nifty 50 is means it's a very good sample set to talk about a large cap space. Similarly, even in mid cap, to an extent, you're talking about 100 and the stocks are 250. So you're talking about broadly sort of it takes care of most of the mid cap. But small cap, when you talk about your indexes are 100, 250, and the area is in thousands, right? So if you have got thousands of stocks and then your sort of index is just 100 or 250 stocks, means we are not talking about huge representation in the index. So if the index gets expensive, it is those set of stocks which are getting expensive. Because small cap to me is a very bottom up place to be in, And bottom up at all point in times, you are going to find ideas which are cheaper. Just to be frank, I've seen when certain areas which the market likes tends to get very, very expensive, and certain areas which the market doesn't like remains cheap, even in the small cap space. So I'm not much concerned with the entire small cap. Yes, index you can say that okay, I mean maybe there could be some sort of, but not on the small cap space.
So I want to also quickly touch upon an area which you look at closely, and there are 2-3 things happened. First, RBI came out earlier, kind of saying, in fact, our finance minister also kind of did a nudging to NBFCs to be gradual out there. People got nervous about NBFCs. Then RBI came out on the consumer loans frenzy. Then, of course, now the RBI's norm about NBFCs investing in AIF. Repeatedly, but the fact is that many of them on growth front, on asset quality front, are not showing any signs of worsening. How are you looking at this space right now? What part of the cycle are we there?
So my view is the best of the credit cycle is behind, right? Where we had almost negligible NPL formation in the system. So that best part is behind in my view. Now, when you are looking at this particular space, what we need to understand is that it is like a funnel, right? What goes in the funnel comes out after 1, 2, or sometimes 3, 4 years, right? So what you are getting today, the credit quality you are getting today are the ones in a lot of cases are the ones which have been underwritten somewhere in 2021, 22, 20. So this was the time when people were very, very conservative. Now, and that's why I think a lot of even the regulator or the finance minister is talking because they don't want the funnel to be filled with sort of bad assets and something which is because the things which are coming out are great. So this is a very good thing to happen because eventually means you don't want to get into a big sort of NPL cycle. But I think the best part of the cycle is over. I'm not overly concerned on the credit quality of the system because I think we are still very well there. But we are not going to see phases of almost zero credit cost.
Okay. Santosh, I also like the call which you took about 6 months back on IT. It was under-owned, it was not very loved, and then everybody wanted to latch onto it later on. Good, heavy, very hefty returns since then. Right now, which part of the market do you think is being ignored? On risk-reward basis, it's turning into an attractive zone.
I still find IT, see, the bigger call to me is the interest rate cycle, you know. And my view and why I got bullish on IT was just because the view was that the interest rate cycle has peaked out. And if that was the case, and because these companies were not sort of doing badly on order wins, what was happening was there was a delay in execution of the orders because the banks they were working with were concerned with the overall economic scenario in the US, right? When the interest rate cycle becomes sort of much more stagnant, or you can see that there could be a cut in next 6 months or 12 months, you tend to start spending, right? And then the market sort of takes view before they start spending. So that was the bigger call. I still think IT has a lot to go. I really still like the space. The space which I think is totally ignored, and since you showed my portfolio beforehand, you could see that I have a lot of health insurance, right? I have very little bank, but a lot of health insurance and capital markets, you know. Because capital markets, I'm still very bullish on. I still think that the biggest financialization is going to get played through the capital markets. So that's a space I'm still very bullish on. And health has been a place where the market has been very bearish for multiple reasons. I don't understand much of those reasons, but yeah, the market has been very bearish. I think it's a space which has got very high longevity, and at the same time, this is a space where the competitive edges of the company can stay for a very long period of time. So yeah, those are the two spaces I'm really liking.
Right. Okay. So the other one, the point I want to talk about, referring to, you may have heard, everybody right now is trying to dig more that if policy continuity actually is seen in FY20 in 2024 elections, then where will be the next area of reform? Railway, defense. Already a lot of work is being done, and we have the visibility. Much of that is already being captured by the listed companies. Capex theme, same is the case. Where do you think the next leg of reforms, there's scope to be done? Because this government harps a lot about reform and economic development as their main agenda. Anything you've looked at?
So this is generally my view is whenever the reform happens, that next 1 or 2 years you have a problem if there is a large reform. And after that, you reap the benefits of that. Whatever we are reaping the benefits, I say that in manufacturing, we are getting orders of what was announced much earlier. So starting from Made in India to Atmanirbhar. Made in India, when it was announced, we didn't see a lot of traction happening in manufacturing of capital goods stock. But the execution remains the key. So for me, it's not about reforms, it's the execution of those reforms, right? And some of the areas of the manufacturing capital formation still remains at top of my mind. Other area which remains clearly at top of my mind is payments, because that was the area where the government had done a lot of reforms, and now the time in next 6 to 12 months will be there to reap the benefits of it, because the initial phase is about spending, right? And eventually the companies which have done really well in that space, they are going to sort of benefit from that. So that's the another area. So definitely capital formation, manufacturing, payments, these are the areas I think get the benefit of the reforms which has happened in the past.
Right. Well, that's the case as far as some of the calls are concerned. I want to dig a little more deeper into the power ancillary space, transformers, wires and cables, some of the tower operators, which, or even motor companies, engine makers, which part of the power value chain are you bullish on? Have you worked around it?
So if you ask me, I'm bullish on the entire space. The question is not about being bullish on the problem is how to play it, because you need to get companies in those particular spaces which you can you can bet on for a very long duration. So that has been some of the problem with that space. So you need to find right companies which you can sort of bet on in that particular space. I still find that sort of utilities is a good area to be in. So the power utility is even is a good area to be in. That's what I think.
Word, from the financial space, one particular stock, a card, a credit card company, pure play credit card company, had been badly punished in the last 2-3 quarters because of weak results and also the guidance of the management on near-term challenges. But the recent credit card data seem to be suggesting that, there is improvement in operating metrics. What are your thoughts on credit card as a play in the market and the valuations these names are trading at?
So see, credit card all started with when the problem started with the RBI guideline, or I would say their intent to sort of have a cap on the MDR, right? I don't know if they had the intent or not, but the market expected that there is an intent of capping the MDR. That's where the sort of de-rating started in the system. Because we had no view on how the future of the earning will be if there is a cap and where will that cap be. So that was the first thing. After that, if you look at the volumes have been pretty good. Volumes have not been a problem. The problem has been around the fundamental shift in the behavior of their customers, right? Because they are not revolving too much, which means the yields are falling. And now the problem is another one, which is if you look at the lower end, which is the on the spending, there is a slightly heightened credit cost in the system itself. And that's why you could see that RBI coming out saying that you don't want the small ticket loans to become very big, or the proxy of credit cards, that those are the BNPLs to not become very big. So that's the area where the credit cost is now becoming a little bit of problem. So it all started with MDR, followed by the change in customer behavior, and now with this. But if I'm looking at say 5-7 years, I think it's a space where one can be in, because this is still under penetrated, and whatever the caps are, I don't know if there would be a cap or if there won't be a cap, but whatever it could be, eventually the companies are going to sort of work around it, and this is a highly profitable business, so I'm not worried about it.
All right, Santosh, we'll let you go on that one. Thanks so much for joining us.